Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, and it's September 27th. Hope you guys have a wonderful morning so far. We do got a few economic news releases to go over today, and we'll just jump right into it. We'll start off with our weekly jobless claims that we have every Thursday. So last week we had a really low report here, which happened to be the sample week, which you need to take into account for because it's the sample week is what the Bureau of Labor Statistics use towards their jobs numbers. So that's their sample week for initial jobless claims, and they use that in their calculations to formulate the jobs numbers that we see every month, and that will be released next Friday. So that could translate to a pretty strong job number next week coming out. Forecast was supposed to go up to 216, and it came pretty close to expectation of 214,000. So for a few weeks, we're below the 210 range, and we jumped up above the 210 range briefly, 214. So we'll see if this continues. But again, these are these are historically lows actually. So this is fantastic news seeing this low for this long here. GDP revision. This is the final revision we get, and then next month see the initial review of the third quarter. So this is the final revision for the second quarter. We had 4.2 in the last report, and then forecast is supposed to have a slight uptick to 4.3, and it remained at 4.2%. So again, very strong numbers here with our GDP, especially with all this tariff talk and everything going on. And we also got durable goods orders in August. So July it dropped 1.2%. Forecast was supposed to go up 2.2%, and it exceeded that to 4.5%. Now, when you strip out the big items here like transportation, it went up 1.5% in July, but in August it went down 0.5%. So that kind of shows you how much of those big ticket items like transportations can obscure those numbers of durable goods orders. So we go from -5 or minus half percent to 4.5% in durable goods orders. So again, it kind of gives you a gauge as to how much those big numbers can really obscure it overall. Last but not least, we got the pending home sales. These are contracts that are signed that are in pending sales. In July, it dropped 0.8%, and it dropped further in August to it dropped to 1.8%, a little bit further down. So again, a lot of it is inventory levels. We just don't have a lot of inventory levels right now here. And locally here, we're seeing a lot of homes over the $1 million range, which over the $1 million range is basically they're kind of sitting a little bit longer with the new tax laws kicking in. A lot of people are probably a little bit more hesitant. Plus, probably even more of a reason is the interest rates are rising. So the rising interest rates, home prices going up. They're going to be a bit more expensive as well. So the homes over $1 million, at least locally here. I live in Redondo Beach, and those are up a little bit. Our average home price here is about 1.2 million over here, so it kind of gives you a gauge as to what those are kind of sitting a little bit longer. Anything under a million are moving a little bit more. It's considered a little bit more affordable, so we're starting to see those continuously move quite a bit here. So let's kind of move ahead here to the headline news. The stock market is up. They've kind of absorbed the Fed's announcement yesterday. They took out the accommodative stance here. So, but one of the things that they did see, it's almost imminent now, basically in the reports. 12 of the 16 four governors, voting members, said that they plan another rate hike this year, which will be December, and then 3 more hikes next year. Now, next year could be interesting because the Fed basically wants to be more transparent at all their meetings. So every meeting now could be a potential time for them to raise rates. Now, typically, before what they were doing is they were raising rates only during the time when they were getting more press coverage. So meetings that they didn't get press coverage or TV coverage, they want to be transparent, so they want to be on the TV and all that stuff to talk about a rate hike. So they kind of planned those rate hikes around that time period. Now, every meeting they do could potentially be that because they're going to be more transparent and have more press coverage during those time periods after every meeting, and that way they can give them a little bit more leeway in terms of raising rates or at any given time. So at any given moment of their meeting. So just be cautious going forward. It's going to be interesting to see how this plays out next year because it could be a little bit more of a guess as to when they might raise rates. But the forecast, the dot plot, according to the dot plot yesterday was 1 more this year, so 4 total this year, and 3 more next year. Also, they're kind of watching, of course, the tensions rising between China and U.S. U.S. is, kind of they're accusing U.S. being trade bullies and trying to be America first, and of course now we're kind of shooting back and accusing them of manipulating our midterms and stuff like that. So again, there's going some back and forth between U.S. and China here, and something to keep an eye on as well. Let's kind of move forward to see how this is affecting the bond market. Oops, sorry about that. Bond market's down a little bit today. We had a nice rally yesterday, but so far today we kind of pulled back a little bit, down about 8 basis points. Not quite, a lot of blenders didn't price in for the better yesterday, but it could be because we're down a little bit. It might be slightly better than where we were the previous day. So I think you're going to see a slight improvement today. Even though we didn't get the pricing for the better yesterday, but because where we started the day yesterday and where we left off the day before, I think we're going to get slightly better in pricing today. Here's the yields. Yields went up about 1 point, so they're up from 3.06 to 3.07 right now. And again, it's got a little room here, and we got more room for it to continue the trend here because, as you can see here, the yields are overbought position, and the mortgage-backed securities are an sold position. So we still want to try to get between the red and green lines here to get more of a normal position here, and we haven't quite yet gotten there yet. All right, so that pretty much wraps everything up. I think we're going to have you'll see a little better pricing today on the lender rate sheets today, and if you guys want to get more updates throughout the day, just come over to Twitter. You can find me at Mike Bjork. I do post throughout the day, so you'll be the first to know of any changes in the market. You guys have a great rest of your day. See you tomorrow. Thanks for watching. Bye-bye.